All right, good afternoon, everyone. On behalf of Telemus, Andy and I would like to thank everyone for joining our second webinar of 2019, where we'll be talking about tax considerations for a dynamic political environment. Now, if you missed our first webinar of the year on how to spot a con, it was an interesting conversation, and you can also catch a playback of this presentation on telemus.com, where we keep all of our original content. With the passage of the 2017 Tax Cuts and Jobs Act, it's created some unique planning opportunities that we'll be talking about today. In the user frame, you'll be able to raise your hand if you have any questions, as well as type in your questions, and we'll be able to get to them at the end of the presentation. We'll be talking about 15 to 20 minutes throughout the presentation, and if you're not comfortable asking questions on this platform, we can we'll be providing our contact information so that you can reach out to us directly. And if you're a current client, you can always reach out to your primary advisor here at Telemus. So to introduce ourselves, my name is Bob Hodgkins. I'll be your co-host this afternoon. I've been an advisor at Telemus for almost 6 years now, and I'm joined by our feature speaker and my fellow Telemus colleague, Andy Bass. Andy is Telemus's Chief Wealth Officer and is a resource for all of Telemus's clients. He's instrumental in developing strategies for some of our most sophisticated client relationships, and throughout his career, has advised some of the most affluent families across the country, really. Prior to joining Telemus, Andy was a partner at one of the largest accounting firms in the country, and his primary role was to provide tax planning advice for families and closely held businesses. He's a great resource for all of the advisors at Telemus and all of our clients, and we're lucky to have him on our team. So with that being said, Andy, I'll turn it over to you.
Thanks, Bob. Before we delve really into any details on the subject matter today, I wanted to set the stage for what we're going to cover. It's now been slightly over a year since the tax law was changed. Since then, we've all been inundated with explanations, summaries, and in fact, many of us may have actually started or finished their 2018 tax return, which reflects the tax law changes, and have either had positive or possibly even negative surprises. Our goal today is not to rehash all the changes in the new law that has been brought about by the legislation and subsequent regulations, but rather to talk from a strategic perspective, how you may approach the next few years, given the law changes and given some of the structural issues in the law, as well as what we see in the political environment today. Tax planning has always been, but now is more so, a strategic process that needs to be approached together on an integral basis with one's overall financial plan, rather than being viewed as a single standalone once-a-year tax preparation chore. As you know, at Telemus, we start our financial planning process by creating a multi-year financial life plan so that you have a better understanding of how life decisions will impact you reaching your financial life goals. It's critical for proper tax planning to really incorporate into your life plan tax issues. And especially important, and we'll point out today why this is going to become a critical issue for you to deal with your financial planning team, including your tax preparers and legal counsel. The current tax law changes has created a situation where many of the planning concepts will depend on a family's current or future wealth. In fact, the current changes in the estate planning aspects of the law has resulted in, for most people, income tax issues becoming the major planning point as opposed to estate planning issues. But as we'll see, we're in a dynamic environment, and that part of the law is set to sunset. So with that, let's start reviewing very quickly what we're going to be talking about today. First, I want to give just a very, very high level of some of the major issues the tax law brought about. We're going to spend very little time on these issues, but they're critical. The most critical aspect of the new law is the fact that in order to get the law passed, there had to be sunset provisions built into the law for budgetary reasons. As a result, starting in 2026, many of the provisions are sunsetted away, and we revert back to what the law was prior to the law change. We all know that the tax law basically lowered tax rates and attempted simplifications, but with the simplifications became many issues, including deductions were eliminated, standard deductions were increased, kiddie tax issues, child credit issues were all changed, and all of that creates an environment where, from an individual viewpoint, strategic tax planning is even more critical. From a business tax perspective, we all know that business taxes have been significantly lowered, and as a similar aspect, individual business pass-through income is getting the same 20% deduction subject to income and certain attribute limitations. And as I mentioned previously, the estate, gift, and generation skipping tax exemptions have doubled under the new law for decedents dying before December 31st, 2025, currently being at 11.4 million per person, and after 2025, reverting back to $5 million on an indexed adjusted basis. Regulatory changes have also increased planning opportunities via withdrawal of certain restrictive valuation regulations that were being proposed by the IRS, and confirmation of no clawback of pre-2026 excess gifts, and we'll talk about that in more detail. Keep in mind, as we go through this presentation, there are certain aspects that will apply to very few people. In other words, currently very few Americans are subject to the overall estate tax. But everybody will be subject to income tax consequences, and the interplay between estate taxes and income taxes is really where the planning opportunities lie. So let's kind of highlight some of the major wealth planning changes. As I stated earlier, for large taxable estates, maximization of the current $11.4 million lifetime gift tax exemption is critical because it is due to change. And we'll talk again a little bit about not only is the tax law reverting back in 2026, there's already been proposed a new law, actually proposed on January 31st by certain elements in Congress that attempt to bring down the exemption even further than what the current law contemplates. We'll talk about that, but also keep in mind, this is a lot of rhetoric going on right now. We're in a period of pre-election positioning, and the likelihood of any major tax law change happening before the next election is somewhat questionable. On the other hand, depending upon the outcome of the election, which surprisingly is less than a year and a half away, we could see subsequent to an election major changes. One thing that I want to point out, and why planning is critical at, before 2026, if not before the next election, is that the ability to use this exemption from estate and purposes and for gift tax purposes has been enhanced because of changes in the proposed valuation regulations that, as many commentators view, that 11.4 million could actually be used to transfer almost up to $100 million of wealth, especially if a lot of a family's wealth is in a closely held business. Right now, the one segment of our population that absolutely has a critical planning process to go through is this ultra high net worth segment where estate taxes are currently applicable to them and they have excess resources. So let's delve into that group first. First, let me say this subsection, in other words, families who will be subject to the estate tax, is a relatively small group, subset of our population. It's estimated that annually only less than 5,000 estate tax returns will be filed annually under this new law. So not that many families are going to be subject to the existing estate tax. On the other hand, because the gift tax and estate tax are intertwined, the ability to transfer wealth under the existing law is at the greatest apex that it's ever been and really needs to be taken advantage of, especially when we don't know what's going to be happening in the future in our political environment. Keep in mind that under this provision, the IRS has confirmed in November through proposed regulations, they can be changed, that there will not be a clawback if somebody makes a gift today and then in 2026, the exemption for gift tax purposes reverts back to $5 million. And what that basically means is that if somebody, let's say you've never done any gifting up until this point, you can make, as an individual, 11.4 million of gifts, or as a couple, double that, and permanently exclude from your estate and potentially future estates of your family members that excess gift over and above what the exemption is going to revert to, down to $5 million. So you basically have the ability to remove 13 million of absolute dollars or whatever leverage benefit you can get by gifting $13 million from future estate taxes. Keep in mind that the effect for this group subset, the benefit really applies to pre-2026 gifts in excess of the lower exemption level. So important point, if currently you've never gifted anything and you gift away $5 million, and then the exemption reduces back down to $5 million in 2026, you're not really gaining anything. However, if you gave away $11.4 million and then the exemption drops to $5 million, you've permanently received the benefit of that extra $6.4 million that you've given away without it ever having to be clawed back or being subject to estate or gift taxes.
So Andy's going to now kind of dive into some of the different, strategies that you can, implement to help, alleviate, or, gifting strategies to, alleviate some of this estate tax burden. So Andy, kind of dive in here.
Really, what I just want to talk about is, again, the key here for this group of people, and I want to reemphasize, families that are subject to the existing estate tax and have excess resources, and excess resources we defined as wealth demonstrated in the life plan where you have resources more than the wealth necessary to achieve your family's goals and aspirations. So you have the ability to transfer wealth currently without it impacting your ability to achieve what you want to achieve over the rest of your life span. One of the things, obviously, that you're going to want to focus on is, how do I give that money away? What's the most effective way to give that money away? And one of the areas that I think you need to work with your professionals on is really dynasty planning. Dynasty planning basically means you have the ability to give wealth away so that it never will be subject to estate taxes in the future. Currently, if you gave outright, as an example, dollars to your children, and you gave it to them outright, and they then passed with that wealth in their estate, it potentially could be subject to estate taxes. Dynasty planning is a way to use trusts so that they have access to the resources of the trust, but the trust principal at their death is not part of their estate, and it just basically follows down bloodline to your grandchildren and future grandchildren as they may happen. So dynasty planning is a critical element of how to accomplish and utilize this excess exemption that you have right now. Another tool that you are seeing people use to enhance how they transfer wealth is what's called intentionally defective trust planning. An intentionally defective trust is not something that was made improper. In fact, what it really is, it's a trust that takes advantage of the differences between income tax law and estate tax law. So basically what happens, you have the ability to sell assets. Again, the advantage of selling assets is that it's not subject to the gift. You retain your gift and estate tax exemption, but you've now transferred wealth to a trust where for income tax purposes, it's deemed still to be yours. So when you sold an asset to this trust, there was not a taxable event, but for estate tax purposes, the growth of that asset in value is out of your estate. So it's typically used, and we'll talk about it later on, as an estate freeze concept, as well as an estate wealth transfer concept. The key here, and both in this subsection of our population, is to basically freeze or slow down the growth of an estate. And both defective trusts and other planning techniques such as grantor retained annuity trusts and other planning trusts are mechanisms in place that are an attempt to move growth of an estate to another generation without using, or potentially with using, minimal amount of your estate and gift tax exemption. So what basically for this subset of the population, the key again is, how do I get the most bang out of the buck for using that excess exemption that is scheduled to be cut in half in 2026, if not sooner with an election change. I also wanted to point out that we don't know what's going to happen in the future. We don't know if estate taxes are going to go away, but I think if you look at the month of January in Congress, it will give you a hint of what I think we're going to see over the next few years. In the Senate back in January, certain elements of the Senate proposed eliminating permanently the estate tax. That obviously got a mixed review. So other elements of the Senate actually proposed, and there's currently a proposal in the Senate right now to tax greater wealthy families under the estate tax. As I talked about here, the existing legislation that we talked about, the 2017 law, is scheduled to bring the exemption down from 11.4 million to 5 million in 2026. This new legislation attempts to bring down the exemption to $3.5 million, as well as eliminate the ability to do large gifts. So do I think either of these provisions are going to be come about? The answer is probably no. On the other hand, it gives you a feeling of what's going to happen in Congress, and we're all living in this world of unknown with what's going to happen in 2020. So the key is plan now with what you have now, because you know that it probably is not going to get any better than it is right now, especially given the deficits.
And this speaks to why this is, critical at this point in time while you have these different advantages in the law.
So everything we've talked about now really come about. You have to ask yourself two questions. Are you subject to the estate tax, and you have excess resources? If the answer to both of those are yes, that you do have sufficient wealth that you're subject to the estate tax today, and you have excess wealth, now really over the next 18 months is when you should be considering implementing some of these strategies to transfer wealth, or at least minimize the growth of wealth, because you know you're at the forefront of whatever changes Congress brings about. I'm going to move on now. Keep in mind that everything also for this subset of the population, everything we talk about for the rest of the presentation applies to you as well. But the difference is, for most of the next group of subset of our population that we're talking about, you may or may not be subject to the estate tax. And so therefore, income tax becomes a bigger issue to deal with. So unlike the households with significant excess wealth, planning focuses on flexible strategies that focuses more on freezing net worth, limiting the growth versus pure shifting of wealth for this group of people. And again, I want to emphasize what the title says. This is the group of people that may, and I say may, be subject to the estate tax when it reverts to what it will be in 2026. And while you do have high income, you might not have enough wealth, or you might just have enough wealth to achieve all of your life aspirations, so you can't afford to give away too much of your wealth. So the focus of this subset of the population would include some simple strategies as well as more complex strategies. These strategies are intended to more what we just previously talked about, freezing. In other words, trying to maintain your wealth you have, but not make it any larger, and do it in a flexible manner. So the simplest thing is you can use what or the IRS has designated as an acceptable loan rate, and loan money to other members of your family. At right now, you can do it at under 3%, and any growth over 3% then becomes the recipient's wealth and is out of your estate. Another way to do something very similar is a grantor retained annuity trust. The grantor retained annuity trust basically is similar in concept to an intrafamily loan. You basically just take an annuity back, and the principal, anything over the annuity value and the principal value ends up going to the next generation as well. Intentionally defective trusts work great for this subset of the population. You can sell, and especially true if you have a family-owned business, you can start transferring some percentages of your business to the next generation without basically giving up the current value of the business and just transferring the future growth of the business. Especially helpful if you have a liquidity event that you know that's going to be happening in the future that might increase the value of the business dramatically. Another transaction that may be of benefit to you are some tax and income arbitrage strategies, where you can transfer income producing assets through through one of the above concepts to other members of the family who may have be in a better tax position than you are. And then I wanted to talk about the next subset of the population, and this is really, probably the largest subset of the population, but it's really those families that are not expected to be subject to the estate tax, and what should they be doing in today's environment. In their situation, they're not necessarily concerned about wealth transfer or wealth minimization, because they do not feel that they're going to ever be subject to the estate tax. Their focus is more on income tax. How do I minimize income tax while still considering all the other strategies we talked about? Obviously, focusing on shifting income and arbitrage rate differences is something to be considered. Keep in mind that with minor children, it's very difficult. In fact, it is probably does not make sense, because minor children are subject to a kiddie tax. But with older children, it's very possible that you can look at shifting and arbitraging rate differences as well as between generations. One of the most important issues that if there's nothing else that you get out of today's presentation is that there are what I call tax basis enhancement strategies due to the current law, which is at death, assets get a step up in basis. So one of the strategies that has been around forever, but now is getting much more interest, and it really, while the strategy was available when the estate tax exemption was 600,000 or lower, or lower than 3.5 million, it was hard to implement. But now with the higher estate tax exemption, it's much easier to implement. And what that is called upstream gifting of low basis assets. Perfect example, we'll go through some examples later on, but basically what this is gifting assets to a generation that is older than you, that with the hopes that you'll be able to get a step up in basis when that generation passes. And it's not only to be used as a way to get a step up. Sometimes we're finding younger family members are actually having to support older family members. So one way to do that is by gifting upstream to a parent at income producing assets, hopefully ones that have a lower basis. So they're supporting themselves because they're typically also at a lower income tax bracket. They're supporting themselves for the income from those assets. And then when they pass, they come back to you with an enhanced step up in basis. Pass-through entities are also a way to shift tax impacts, as well as spousal trusts and enhancements necessary because of the tax law changes. One hot button that you need to take a look at is that if your estate planning documents were done before 2010, you really need to have them looked at, because a lot of the planning structures that were in place prior to 2010, when the exemption was much lower than it is today, resulted in what's called a family trust and a marital trust. And the family trust was out of the spouse's estate. That was great in the past when you were trying to minimize estate taxes, when the exemption was $600,000 or some lower dollar amount. But in today's world, you really want to get a step up in basis multiple times at both spouses passing, and so you want to make sure that your estate planning documents are structured to take advantage of step up in basis at both spouses passing. Some other things to consider are, and why it's important to have a long-term life plan, is multi-year tax bracket planning. You may have a taxable event that throws a family into a high tax bracket in one year, and in future years they're in lower tax brackets. So by understanding multiple tax brackets and how they apply each tax year, there may be ways to smooth out the income tax imposition by managing your tax brackets. Tax deferral strategies, we're all familiar with real estate and 1031 transfers, which are like-kind transfers to basically defer payment of taxes. The tax law brought about also opportunity zone planning, and these are unique vehicles that basically have the ability to defer taxes for, again, only through 2026, but then as long as you hold the investment long enough, permanently exclude any gain on any investment that you buy with your deferred assets. You still are going to have to pay taxes, 85% of the taxes that would have been due on a sale of the original assets, but any of the investment that you buy potentially will be excluded and not be subject to taxes on its growth. Qualified retirement plan maximization. There are a lot of interesting ideas, both in qualified retirement plans and using life insurance planning as a way to minimize income taxes and maximize wealth passing to the next generation.
And so for everyone on the phone, I know this has been kind of a lot of information that we've talked about so far. So as Andy said earlier, we're gonna work through a couple examples here so that you can kind of see how some of these wealth transfer strategies may work.
So here's an example. Let's assume an individual a number of years ago bought for $100,000 some asset that's now worth $1 million. Let's just make it simple and call it stock. And if the stock was sold, there'd be a $900,000 gain with an estimated tax of $252,000. So what can that family do to avoid having to pay that $252,000? To avoid the gift, let's assume that you're an only child and you have an elderly father who is very low net worth and not subject to the estate tax and will never be subject to the estate tax. So under current law, when his dad passes away, and assuming if you gifted that asset, in other words, let's say you gifted that stock worth $1 million, with a basis of 100,000 to your dad, to your father. That asset now becomes your dad's asset. Carryover basis continues. Your father would end up continuing owning that asset. When he passes, and assuming he held the stock for at least a year and then leaves his entire estate back to you as a son, you will get that investment back with the current fair market value being the tax basis. So will you technically, by doing this upstream gift, have avoided having to pay $252,000 in taxes? There are risks with that.
And one question, Andy, so when, with, the rising costs of, healthcare and health insurance, if you were to gift something like this, would this be considered an asset that they would have to use for medical expenses and so forth that, that could be a problem?
Absolutely. There are a number of risks with this, but there are risks that can be mitigated. First of all, if you're going to be the one getting the asset back directly and your father or your parent or whoever received the gift does not live for a year, they most likely would not be able to get a step up in basis. Although you also have to be concerned about creditors of your father. If your parent who you gifted this asset to has some financial issues, this potentially could be an asset of his that would be subject to his creditors. Because it's an outright gift, you as the child might not have direct control over the assets in your father's last few years. And furthermore, it would be potentially an asset of his that would impact Medicare and other costs depending upon what situation your parent is currently in.
All right.
So the next example that we wanted to demonstrate is the same set of facts, but how do I get around some of those risks? How do I get away from the fact that I'm not willing to take on all of those risks? So in this case, rather than giving your parent the funds directly, you create a trust for the benefit of your father, and you fund it with the low basis investment. Now, at that point, it's still your asset. But if you, as the child, grants your father what's called the general power of appointment over the trust, which he can exercise to allow the trust to give him the money rather than you, but basically it gives the total power over the trust assets to your father, that would then cause that asset to be included in his estate. But because it's a trust, the asset is now in a trust and subject to whatever the trust terms are. So it helps to alleviate the issues of potential creditors of your father, and also you still get the step up in basis. Keep in mind, this is a wonderful technique also if you want to leave money to your children or future generations, because again, you don't, if let's assume you're, for a perfect example, on an outright basis, you don't want to deal with creating a trust. You want to not have this money come back to you, but you want it to go to your children. In that case, that 1 year rule does not apply. So you can outright gift some low basis stock to your father, have your father in his will, have it go directly to your children. And at that point, even if your father does not live a full year, they would still get a step up in basis because the assets are not reverting back to the donor, they're going to somebody else. That's also one of the reasons you use the trust structure, because if you're doing it through a trust, it's possible to avoid the 1 year rule as long as everything else is structured properly. So again, we were trying to keep this to a half an hour presentation. We just wanted to highlight for you what I would call some strategic issues that you have to consider. And keep in mind that, we're in a dynamic environment. We're in a politically charged environment. We don't know, we can't predict what the future is. So you really need to plan with what you have today. And all of these issues that we talked about are solid planning concepts that are not really that questionable, that if you work with tax counsel and your legal counsel, you can structure and really benefit your family by taking advantage of the unique short-term window we have to take advantage of the highlights that the 2017 tax law changes brought about.
Thank you, Andy. That was a great presentation. Just keep in mind that these are all topics that you can talk about when meeting with your CPAs or estate planning attorneys, as well as, we can open up the floor for any questions. If we have our contact information on the screen. If you would like to reach out to us so we can ask any questions.
So I'm going to jump in. So we have a one question that just came in, and also if you have any questions, again, to reiterate, you can use the raise your hand button, or you can ask in the questions field. So we have a question: are there better times of the year, for example, March or December, to do your individual planning?
Well, I would probably tell you that the earlier is generally the better, and it really is somewhat client specific, because you need to have a general feeling of what your what your income is going to be. That's one of the advantages of why we do these life plans. And we update our life plans annually when we meet with clients at certain times during the year, because when you need to know of a general view of what your financial net worth is, and based upon your net worth, you can and what your needs will be, you have an idea of what you can have flexibility with. And from an income tax viewpoint, I would probably say don't wait till December. The best time is probably at least sometime in the third quarter of the year. By then, third quarter is typically a good time of the year to work with your tax professionals. They might have a little bit of a slow time then. And at that time, you can accumulate your information with a decent amount of certainty of what it may look like. And keep in mind, again, planning should not be just an annual process. Planning should be a multi-year process. And hopefully your accountant, CPA, has some projections, not only for the current year, but for years going forward, because typically you find that a lot of income can be planned out. It's recurring, and you can plan for what it may be. But the key is working with your CPA, working with your planner, and not making it a compliance chore, but making it a planning opportunity. Any other questions?
Yep. So we have another question. Eric, I think you're unmuted. Can you hear us?
Yeah, we can hear you, Matt.
No, I'm seeing if Eric's unmuted. So Eric had a question about what about IRA Roth conversions?
Again, Roth conversions make sense based upon each individual circumstance. And without a doubt, the key on doing a Roth conversion is, do you have assets outside of the Roth to pay for the tax cost of the conversion? If you need to rely on the Roth assets to pay the tax on the conversion, typically, unless you're very young and have many years ahead of you, it's hard to arbitrage the tax savings in the Roth to pay for the taxes that you paid for. On the other hand, there are some interesting opportunities of using Roths that make sense, and the younger you start your Roth, the better off that you are. Anything else?
Yeah.
Doesn't look like it. Andy and Bob, want to thank you both very much for the presentation. Again, we will have this session recorded. Please feel free to reach out to anyone at Telemis if you have any tax questions going forward. Thanks, guys.
Thank you, everybody.